In this video, I will show you how to build a simple breakout strategy for the S&P 500 market. The principle is that we will monitor the breakout of the highest price for a certain period, specifically the last 50 days, and we will not wait to see if the market enters a long trend, but will focus on short-term trades with a set profit or loss. This means that we will set a profit target and stop loss so that the position closes automatically as soon as the price reaches one of these limits. It looks very simple on the chart. The entry level corresponds to the breakout high above which we have a profit target and below which we have a stop loss. After closing the trade, we wait for the next breakout and repeat the whole process again. Now what you have to do is to go to Algo Cloud, click on Create New Single Asset Strategy. First, you have to switch tickers to on bar close. And then add the basic condition for entering the trade. The current close must be higher than the highest high in the last 50 days. This defines the moment when the breakout occurs and the strategy opens a position. This time, we will not add any exit condition based on the trend. Instead, we will use fixed values for stop loss and profit target. For the stop loss, enter 10% and 15% for profit target. Select the SPY.D symbol as the market. And once everything is set up like this, run the strategy full backtest. After the test, you can see that the strategy somehow works. The results show approximately 5% of drawdown and a total of 46 trades, and overall the strategy can be considered functional. This verifies the next step is to expand the strategy from one market to multiple stocks in this S&P 500 index. To do this, we have to switch the strategy type to stock picker. In the position score settings, we specify that we want to have a maximum of 10 positions open at the same time and that we will not use any short positions. Next, we add a position score according to which we will rank the stocks. We want a strategy to trade stocks with higher trading volume. Therefore, we set a formula that takes the current volume and divides it by the average volume over the last 20 days. This will cause the system to favor stocks that are currently trading more actively than usual. Finally, we set the S&P 500 market and the time period from 1990 to have sufficient historical data. Then we run the test again. And the results look good. However, you can see dips in the performance curve during periods when the market was generally declining, for example, during the dot-com bubble in 2001 and the financial crisis in 2008. These dips show that the strategy traded even when the entire market was in downtrend, which we could improve with a filter. To limit losses during declining periods, we will add a simple trend filler. Using the subchart function, we will display the SPY index and add a condition that we will only enter trades when SPY is in uptrend. That is, when its closing price, so close, is higher than the moving average of 200 days. So close must be higher than 200-day moving average. Then we will run the backtest again. After adding the trend filler, the strategy's performance curve smoothed out significantly. Loss periods are smaller and the overall drawdown has decreased to about 3%, which is great. Parameters such as stop loss and profit target can be, of course, changed as desired, for example, according to ATR or other volatility indicators. You can also add additional conditions that filter trades according to your preferences. This was a simple example of breakout strategy for S&P 500. Don't forget to like and follow so you don't miss out on the best tips from the world of algo trading.